Okay, so um okay, price was bearish. All right, price was bearish for a long time. It was bearish for a long time. All the way, from the top, it was bearish until eventually price broke structure here. Okay, US broke structure here. So that means it's agreed, right? That price is bound to fall. But now, when it broke structure, it could continue going up, like going up and going up and going up and going up. But it would only go as far as it can find a what supply. So look at this. Let me zoom in so you'd get to appreciate this some more. Okay, as far as it can get supply. The moment it taps into supply, see how tiny this is. It just passed. This is the blue line. Just taps into it and then dropped. The moment it gets to supply, price is going to fall. Okay, so the break of structure, next thing you're expecting is a retest. But when is it going to start retesting? After it has tapped into supply, as in a bullish break of structure, like an upward break of structure. Now when it does that, it comes back down to do what? Seek, to retrace, and it's going to retrace into another what? Zone, which is going to be the demand zone. So if you look at this is what I was waiting for. All right, this is what I was waiting for, and you see how price just tapped into it. Okay, I don't think it has tapped into it yet, but prices will just like come back to it. Let me zoom in. Let me take off this green. You see, price has not tapped into it yet. I'm just going to zoom in. Maybe it's going to do that very soon. You see, but soon price is actually going to, once price touches this zone, it's bound to go up. It's supposed to go up, all right, according to the concept of supply and demand. But this is when you're confluencing this with other like you're not just trading supply and demand alone. Like you need to know if you're at a support level or if you're at a resistance level. Like you have so many other factors to consider. Okay, so that's that. And yeah, so like I was saying, when price pushes away from, like, because of momentum, price just shoots, right? You see it leaves a gap, and the market will try to test that gap. Now we'll call that gap a fair value gap. I'm just going to change this to a line because my chart is already looking crowded. All right, so when price taps the top of the zone, we're going to see it. Okay, let me make it bigger than this. Okay, so we'll call that a fair value gap, and this is what a fair value gap looks like. The high of this previous candle was here. All right, you find the low of this next candle, draw it out. That's a fair value gap. So price either bounces off supply, demand, or it always seeks fair value gap. And all this is trying to do is just balance the market, because the market becomes so inefficient when you have so many gaps, right? So price will always try to go back there and balance it up. So when these two things coincide, as in this case where you have you have demand and you have a fair value gap, it's a good place to take your trade. And then that's when you start seeing the candle printing out what you want the candle to print out. That's why you're not seeing reactions from the bottom like this, because you're not the only one trading the market. Everyone around the world is seeing the same things and they're going to act the same way. By the way, the market is just a representation of mass behavior, right? It's our emotions that's moving the market. It's not one thing. Okay, so even when you're putting your money, you think it's the money that is moving the market. Actually, it's your emotions that makes you put the money. I mean, every expense we make is an emotional expense, whether you think you need it or you don't need it. Even when you're buying food, it's actually an emotional purchase. Okay, so the fact that we have two reasons to take our trade from here makes it a high probability trade. All right, so chances are price is not going to come down to the supply, but let's just hope it's going to come down. So I'm going to put a pending order there, and I'll talk about pending orders and market executions later. Right, let me just write that down, because at these videos I'm just doing it off the top of my head. I didn't really plan, get a curriculum or something. I actually tried to get a curriculum, but it doesn't flow in my head because I had to stick to the curriculum. Okay, so other types. I'm talking about supply and demand. Okay, so let's see. right? So this is how the market makes all its stops, all the stops it makes. I'm going to show you somewhere else. I'm going to show you somewhere else. So I'm going to take a bullish. This was price was quite bullish. The market was quite bullish here. Okay, so we had this low, had the high, had the low, and then price broke structure here at first on this time frame. Broke the structure because it was high, lower, high, higher. Sorry, lower, low, lower, high, lower, low, lower, high. You know, this was the last low price made, and then this was the last high. Okay, so it was from after this low price made this high, then price now eventually broke structure. So this is the most recent high before this swing happened. Price just pushed above all of it and broke the structure here. All right, so I'm going to make this break of structure. Okay, so when this happened, price had to retrace. It had to tap into supply or demand. All right, this is not the only thing that affects price anyways, but like supply and demand is the core of why price moves up or price moves down. But like the other things I'll be talking about, more advanced topics. All right, but price has to tap into these things, and if you look back, look hard enough, you're going to find something. You just have to move between structures, between time frames. You're able to find something. So let's take this for instance. You know, price took out this high, right? Reacted, but it was not done. It had not gotten the gas it needed. It had to go up to seek what? Supply, which is this. And you see how price had some kind of reaction from here. Still some kind of reaction. But even if you're going to take your sell from here, your stop loss has to be above the previous high, which is here, right? And then you target, you know, wherever that's if you're going to trade a retracement. It's not advisable for novice traders to trade retracements because you don't really know how to control, you know, do certain things. All right, let's go back to our 15 minutes and zoom. Where's that candle pattern? Okay, so price did this and then price dropped. So if you look at this candle, you see that the point where price, you know, gained momentum was this candle, and the candle before it is this candle, this bearish candle. So if you mark that out and drag it to the future, that's a demand zone. All right, so you see how price came down. So even if you're taking this sell, you will just target the top of this demand zone, and then from this demand zone you take your buy, because when price meets demand it rises. Stop loss below the previous low, and then you aim for the high. Okay, but I was talking about showing you guys a tool you can use, and that's the Fibonacci tool. For those who know what it is, you know what it is. You know what it is for. It's a Fibonacci retracement tool, and I don't use it anymore. So where is it? Okay, Fib retracement. All right, but what this tool does is it is used to measure retracement. All right, so if you want to measure, this is a push, this is one like swing. You want to measure how many percent of this swing did the price retrace to, and off the top of my head I can say this is like 70%, but it's always a zone. It's never a precise number. Price is not always going to respect a precise number. All right, so I actually changed my own settings because I didn't need those other settings, but normally it has, you know, 30%, 60%, 20%. It has, like, you can customize it to suit your, you know, whatever, right? But if you come to your Fibonacci tool, retracement tool, so this is the tool, right? It's selected. You click on settings, you click on styles. You're going to see all these different levels. All right, you're not going to find this 0.27, negative 0.27, so you have to impute that, and when you impute that, it now shows up on your chart. I don't like all these colors. I'm just going to make this green. So I'm going to check off the background. All right, I just want the lines, these zones. So negative 21 is negative 27 is a, that's this. It's a level that price is very likely, it's not a must, it's not mandatory. Price is very likely to come to. Okay, so you can do this and backtest as much as possible. So when you're trying to measure retracement, you start from the beginning of the push the market made, they end at the end point of the push, right? And then this tool brings out the different levels, different percentage levels. And this is 60%, this is 70%. So this thing retraced around 80%. Around 80%. But what I was trying to show you guys was this negative 27. The price is very likely to come to negative 27 most times. Okay, I'm going to show you another one, which is, let me use this. Okay, this was the one we measured. This is even beyond negative 27. So if it does negative 27, it goes to negative 61. This is just high probability zones. It's not a must. The market does not owe you to always, play around that zone. So I'm going to take this beginning of the move, end of the move here. And then if you're able to catch your trade from here, for instance, instead of just targeting this high, you can target negative 27 and you get extra cash for that. But you have to be careful because the market is not always going to if the market is going to change trend, imagine the market wanted to change trend from here and it does this. Okay, it does this, and you're expecting it's supposed to continue the bearish trend, but market wants to change. It's going to either test this high, this low, or take out the low and then go against you. So that would have resulted in a bad trade. All right, so that's why it's advisable to just always target the recent high. But when you're sure the trend is going to continue, just target negative 27 and you're always going to keep hitting some money. All right, so just always target the previous high. Okay, sometimes it makes a lot of difference to get that extra money, sometimes it does not. All right, so it just depends on you, and with time you're going to be able to use this more times than not. I don't use negative 27 anymore because price does not respect the Fibonacci retracement, so price actually respects supply and demand. All right, but there are times when it's just cool to just go back to the old way of trading once in a while. I'm sharing this information with you now so it can help you, but for me I actually know better than to use that. All right, so you can always use that. Let me even show you what the negative 61 is like. And just because this is the Fibonacci is a mathematical it's a concept. It's a highly precise mathematical construct. All right, so it's a sequence. So all these numbers are not just coincidence. They're not just coincidences. Okay, so it's a sequence. Like you can see here, beginning of the push that broke structure. So you take record, like you mark that where the move ended. All right, price came here, and then you're targeting negative 27. Okay. Right, so you target negative 27, and let me put back my negative 61 settings. Let me see if I have it marked up. Okay, negative 61.8 actually. Right, so this is a new zone, a new target to hit, for price to hit. And all you have to do is just check if price is actually going to, if there's a reason for price to come back there. Maybe there's a demand behind for price to come back there. If there's no reason, just stick with your shorts, your little profit, and just go your way. Right, just go your way. The market does not owe you. Matter of fact, if you had not learned how to trade, you wouldn't have even been in a position where you're making money. So just stick to what works and just keep getting your crumbs, the breadcrumbs. Keep picking that up until eventually it's going to grow, and then you can now start making big bets. And even when your money grows, you don't even need to make big bets because your money is now so much that you can, get more from small moves. Okay, so I'm going to show you when price did hit negative 61, and I'm going to use this Fib retracement. So why am I, you don't just measure any retracement. You look for the retracement, the move that broke structure. Price was bearish until price broke structure here. So you look at that, right? And then you target these two targets. Let me just draw a rectangle that spans across the two targets. Negative 61, negative 27. Alright. You see? Boom. Price went up at first, tapped into negative 27, reacted off that for whatever reason, supports supply and demand behind, supply behind, so that's why it reacted, and then eventually it came to negative 61. So this is how it works, right? Each of these Fibonacci retracement levels have what they call projections. So there's also a Fibonacci projection tool that projects depending on what price did. Okay, I'm going to share that here. I'm going to share that in the next video. All right, but for now, let's just stick to the negative 27 and negative 61, but use that sparingly. Don't rely solely on that. Use that sparingly. I'm going to share, the negative, the projections and all in another video. I actually don't use them because these are, it's just like giving a baby walker to a baby. It's going to help him walk in the meantime while strengthening his bones to walk by himself. Okay, I would not advise you to rely on this solely, but one thing about trading is that you don't need to master everything to make money. Just know what you know, master what you know, and you're going to keep making money. Okay.